Welcome back to the big show. Josh McCown here. John Edwin, the illustrious one.
Man, we have had such a really amazing 2024, and we want to bring our listeners the top 5. We did over 60 episodes that we dropped in 2024, and we're going to bring you guys the top 5 episodes from 2024 to ring in your new year, and then we'll be giving you new content. But let's roll with these, baby.
If you're hearing this, it's the year 2025. We cannot wait to celebrate an entire great year with you. But wait until you hear these shows. Blast from the past, the best of the best from 2024. Old Lang Syne. Cannot wait to see you guys.
Let's go.
Hi, this is Robert Kiyosaki, and you're listening to Capital Hacking. This is the most important thing you can listen to today.
He's the one.
I have a dream.
With great power comes great responsibility.
I could do this all day.
This is it. Don't get scared now.
They may take our life, but they'll never take our freedom.
Cinderella's story out of nowhere.
It's in the hole. That the only thing we have to fear is fear itself.
Capital Hacking begins in 3, 2, 1.
Welcome back to the big show. Capital Hacking. Josh McCown, John Edwin. We are at your service, right, John?
Oh, yeah, we are. Today's show, we have Andrew Cushman, who's a good friend of both Josh and mine. He owns a company called Vantage Point Acquisitions. And he got a degree. We're not going to give away too much, by the way, but he has a degree in chemical engineering and was working for a company. And talk about being a serial entrepreneur. He was his wife and him got into vending machines. They were trying to make popcorn. They were trying all these different businesses. And then he exploded in real estate.
Yeah. I mean, this is one of the more respected, let's call it syndicators in the world of multifamily. He's made it through 2 cycles. So he's got a lot more wisdom, 2,700 units, lots of really interesting things to talk about there. But I'll tell you what you're going to take away from here that is going to make you some money or capital. Okay. And that is creative financing, master deep dive with case studies and experience and examples. It'll help you. It'll change the way your next deal goes, and it'll be a platform that you can build on for other things. Creative financing. Number 2, deep dive into the world of multifamily today, reading through the news articles, the pop culture belief on what's going on in multifamily. He answers it. He agrees to some. He shows you arguments for the opposite. And one tease here in the end of the show, he's going to tell you the number 1 green light that he's looking for to know if this is a time to buy multifamily. The number 1 green light. That means he's going to give you a secret. Yeah, without a doubt. Totally successful guy giving you the secret. You're going to love this episode. Don't worry, John's dog's barking. He loves the show too.
Let's go.
It is always fun to have Andrew Cushman here, John.
The man, the myth, the legend. Quick story. I got to sit next to Andrew when we were at our last GoBundance event, and we had a lot of fun and talked about mindset and miracle mornings and kids, and it was great. And I really appreciated spending a couple days with you, Andrew. So with no further ado, can you give us a little bit of your background and then bring us up to speed with where you are?
Yeah, I took the standard route into real estate and got a chemical engineering degree because I didn't know real estate was my actual calling at the time. So I worked as an engineer for 7.5 years. During that time frame, got married. Both my wife and I had the mindset of we want to work for ourselves and do our own thing. We just didn't know what that looked like. So we tried a million different things, from vending to making popcorn at home and all that crazy stuff. And then I was one day in the break room at work. I walked by a table that had a Wall Street Journal article open to the business section, and it was talking about flipping houses. So I took that home, condensed it down, learned how to do that. We flipped our first house in Southern California in 2007, made as much as I made all year at my job. I said, all right, that's it. Like, there's no clearer signal than that. I quit, went into flipping full time. My wife quit her job 2 years later and joined me. And then 2009 and 10 were really good years. But what we realized is, like, hey, you flip a house, you make a chunk of money. That's great, but you got nothing left to show for it after. And so we said, well, what builds longer term wealth? And then we also said, all right, we just had a huge recession. So after a huge recession, typically comes a significant expansion. Okay, so we're going to have an expansion likely. Then we said, well, half the country just got foreclosed on and can't buy a house for 7 years. The other half of the country saw their friends and family get foreclosed on and are scared to buy a house for the next 7 to 10 years. So that means we're going to have a huge renter pool. How do we benefit from that? Let's go into apartments. So we found a mentor who held our hand through our learning process and first acquisition, bought and syndicated our first property, 92 units in Macon, Georgia in 2011. And have been doing multifamily investment full-time since then. So I guess we're in year 13 now. It's been a great business. It hasn't been without its challenges, but overall, it's been really, really good.
So drop the mic. Great intro. Really understand you better. But, really succinct. I know it's your triple decker here, I believe, third episode of Andrew Cushman on the big show here. But great intro. A couple other tidbits. You're a major contributor to Bigger Pockets now. Sometimes you guest host with David Green, who we love. This idea that you syndicated in 2011, and you used a mentor before then. Do we still know that mentor person, that group, or is that not around anymore?
I am still business partners with that mentor. We ended up actually at that first deal I did by myself effectively, my wife and I, and realized, holy crap, this is not a solo business. We almost didn't get the money raised. We almost didn't get closed. I mean, it was just like, oh man, this is not something to do solo. And so we actually partnered with him and his partner on the next couple of deals. We actually ended up doing 6 deals together over the years. We're still partners on some to this day, now 13 years later. And it's been a great partnership.
And then, the whole world of syndication. When you went from learning how multifamily, by the way, is that really how it went down, that you thought about the cycle of boom and bust?
That's exactly it. Yeah.
And you thought people are going to be renters because they won't be able to get a mortgage for 7 years? That's pretty basic in one level, but actually not how most people talk about things. You're right. That is what happened, right? People couldn't get a mortgage because they messed up their credit so bad.
Yeah. And again, if people can't buy a house, but we're creating jobs and incomes are going up and there's population growth, well, that means they're all going to have to go rent. So let's provide that service.
Wow.
So that was our reasoning.
That's so cool.
And, so you clearly had an entrepreneurial spirit if you're working in chemical engineering for a company, and then you and your wife are, you said you were in vending machines, and then you were making popcorn.
Yeah, flavored popcorn.
How did that work? Were you successful, or were those failures?
Hold on, John. Everybody knows the biggest money in the world is in popcorn.
Hey, we destroyed the kitchen, but we had a lot of fun that weekend, and the stuff did taste pretty good. But we realized after one weekend, like, no, this is not going to be our thing.
It's the perfectly scalable business. Just
yeah, exactly.
Just kidding. Wow, that was hard.
We've tried flipping cars. I mean, you name it. So
I do know a few people that like doing that.
I mean, it's so fun because I think a lot of us are that way, where we're like, all right, this is what I'm going to do, and this is what I'm going to do, and then it's like we have these different failures, and I think a lot of really successful people have failed over and over, and then they find that thing, and for you, it seems like it was real estate, and then you got into syndicating. For your first deal, I know you did some flips, and that was profitable, but for your first syndication, 92 units, did that scare you?
Oh yeah, and candidly, I would never recommend anyone do the first deal that we did, both in terms of location and the roughness of the property. And the reason we got that deal and the reason we got it closed is because we had about a 50-50 mix of motivation and naivety, or being naive. That's how we got that first deal. We needed to raise $1.2 million, and we thought, all right, that's easy, right? Well, number one, this is 2011. Everyone was terrified of real estate, so getting people to invest in it was not an easy thing. And then we hadn't developed a network yet for doing that. Right. We had some investors that funded our single family flips. That's how we did that business, just private, not quite hard money, but private money. And we're like, hey, we'll bring them over to the apartments. Well, a lot of them did, but there wasn't 1.2 million worth. And so again, we had to extend the contract multiple times. We had 6 figures of expenses on the line if we failed. And eventually how we got it closed, is we went back to the seller and we didn't retrade him on price. We said, hey, look, this thing is in a lot rougher shape than we were led to believe, which was true. So we're going to have to spend some more money on rehab. We're not going to retrade you on price, but we want you to carry a note for $300,000. And then we'll pay you off when we refinance someday. And he agreed to it. And that's how he finished off the equity, was actually the seller himself. Yeah.
And the banks let that happen. That's a whole nother deep dive, but that doesn't always work out for the bank ratio. Somehow you worded it right.
This was all cash. There was no bank.
So the 92 units cost $1 million.
7,500 a unit. That's right. Yeah.
What?
This is 2011, guys. We're like in a different, I don't know, eon.
Do you still
now.
own that? Do you still own that treasure?
No, we sold that. We sold that after about 6 years for about 30 a unit or something like that.
Damn, I wish we.
But no, we do own some today that we bought for. We own one today that we bought for like 7,000 a unit. We still own today.
Wow.
Yeah, it's breaking my heart to hear numbers like that. That's so good.
Well,
So
you know,
good.
you got creative early, because now I feel like a lot of people are doing deals where the seller is holding some sort of a note to get it to the finish line, and that's been happening over a lot over the last few years. But for you to do that in 2012, that was really creative. 2011, yeah. Wow.
Creative financing is making a big comeback right now.
Amen, sister.
Yeah. And by creative, I don't mean financial engineering, which is making something work that shouldn't work. But creative is not, the standard is, okay, go get an agency loan for 70 or 75% and fix it for 10 years, whatever. Whereas creative is like, yeah, all right, well, maybe I do that. And then the seller, I'll give an example. We did a deal just a couple of years ago. It was a larger one. It was 49.8 million, but we got the seller actually contributed 6 million of the equity. And how we set it up is it's a 0% rate. We just pay off the equity every month. We pay it down. So we got 6 million at 0%, and we pay it off every month for the next 6 years. And you're like, well, why the heck would the seller do that? He's making 0%. Well, no, it made it so that we could pay him a little more in the purchase price, and he saved over $2 million in taxes because he deferred the 6 million, and we're passing depreciation through to him. And then now he's got a monthly guaranteed income every month we pay him, right? So like that kind of creative financing helps deals work today still.
Okay, you gotta again now this is where there's debt involved, institutional level debt.
We got it approved by Fannie Mae.
Okay, how did you classify that 6 million then?
So you're exactly right. So you can't have debt behind Fannie Mae from like a seller or something like that, because they won't treat it as an actual sale. They'll treat it as a recapitalization or whatever. And I may be using the wrong terms, but they don't like it. Put it that way. So what we did is we just made it very clear. We created a separate class of equity and we were very carefully that we did not word it using terms like debt. Everything is equity. It's equity pay down. It's not guaranteed. All of those things. And and Fannie approved it. And because we said, look, it's just a special class of debt. And if, property gets in trouble, we'll stop the payments, which of course has not happened. And they approved it. So.
And the answer was obviously the seller knew that it wasn't debt. And so really their collateral wasn't dirt. It was the collateral in your business somehow. So somehow they have a priority over you taking money out, and that gave them peace of mind, I guess.
Yeah, exactly. It's just, and then they obviously know the property, know the market. Right. They had, faith in us to continue to operate it well. And so it worked out.
May I throw this out there, John? So there's something similar happened, and it actually changed the way we do deals too. So typically when we do a creative financing portion of our acquisitions, we did this with Kent, our property in Maryland, years ago, where we told the seller that their collateral is that they have position on our entity that owns the real estate, but not on the real estate. And that seemed to be fine with banks. Same exact structure you're saying, basically a class of equity. But for us, it was, I don't know if we called it a class of equity, but yeah, the point is, the big thing here, guys, is if you're listening and you're saying, well, how do I get creative financing like Mr. Fancy Pants Andrew Cushman? Which, by the way, if you know Andrew Cushman, the guy wears the fanciest clothes, the most decked out.
This
He's
is
always
about as
wearing
nice as
wingtips.
you'll ever see.
No,
me.
I'm just kidding. I know he's casual, but his fancy pants idea is related to what am I trying to get here? Here's the key thing to take away, folks. If you're going to do the ultimate creative financing structure, immediately start talking to the seller about the reality of debt structures and say that the debt provided by a bank will want to have first position and often does not want to see any second position. Therefore, we are giving you either, like he said, a special equity class or collateral of my entity. So that's what we've done. We've said you don't have collateral of the real estate, but you have collateral of the entity that bought the real estate, which means clearly the bankers get full control in lien structure on the building and the dirt. And I think for everybody, if you just take that away from both of us, it'll allow you to get better. It'll allow you to have better bank relationships because, there's another deal we've done where we weren't as precise about this. I had a partner and he was really focused on telling the seller they could have a lien on the building. And I think if we would have just positioned it correctly at the beginning as a lien or a collateral position in the entity that owns the real estate, they probably would have been just as happy. And we would have had a lot more flexibility with that. But right now, we're always going to have to worry about getting the first lender to be okay with a second debt. Did I say that right, Andrew? Is that pretty curious? That's a curious masterclass right there. If people learn that, they'll be better off.
It is, and there's a lot of nuance to it, and it's not fully black and white. For example, we do have another smaller property where the loan was with a small regional bank that I've had a relationship with for over 10 years now. And they let us put actual private notes secured against the property with liens in second position to their loan. And their only requirement was like, well, as long as everyone signs a subordination agreement, then we're good with it. So again, we told them that from day one. We're like, hey, this is what we're looking to do. Are you guys okay with this? Here's why. Here's how the cash flow covers everything. Very transparent and upfront, and just talked it through with them. Like, what do you need to get comfortable with this? And they laid it out, and we just, oh yeah, we can do that, not a problem. So it depends on your lender, depends on your structure, your business plan. But I mean, there are some creative things you can do.
And last pin on this, if you guys don't mind. Everything Andrew said is right. And I think the world's best way is to find these local lenders that you can build a relationship with. But let me throw this out. When you get that business up and running at full speed and you want to keep some debt from the first seller, but maybe add a better debt in the first position that might be a more institutional level, again, clearing the deck of having it up off the real estate is like the pièce de résistance. But anyway, I just say that because Andrew's strategy, what you just said, Andrew, was super the best. If we could all build relationships, as a matter of fact, that's the last thing about creative financing. It really can be done much better if you have local bank partnership relationships. And I am challenging myself, John, and you can hold me accountable, Mr. GoBundance accountability partner. We have to build better regional bank relationships in 2024 because that is the best way. That plus great creative deal making is the ultimate strategy. All right. John, I've taken over the whole mic here. I'm going to pause for a second and let you take over, bro. Drive the wheel.
I just turned into a listener, which was great because you guys have so much. You have so much knowledge that I'm scribbling notes like crazy. So a question that pops in my mind, Andrew, is taking down this first multi-unit of 92 units for $7,500 a door to now you own thousands of rentals. Where did you go? Like, what was the next progression after that building to where you are now? How did that work?
So after that first one, we were like, wow, this almost killed us, but we can see the potential in this business. So that's when we went to our mentor and we're like, hey, what if we partner and you help because he obviously is much more experienced, and said, "What if you help raise money? We find the good deals, and we'll do them together." And he was like, "You know what? We get asked that a lot, but yeah, sure, well, we can do that." And so the next couple of deals, and again, when I say we, it's my wife and I, we found, and then we also raised money for, but they helped so that it got across the finish line much easier and much more quickly. And then we did two of those with them, and then I was at a conference in Arizona, a real estate conference, and this is, if you ever see us do a deal with DAPT Acquisitions, the DAPT. So the DPT is David Osborne, Pat Hyben, and Tim Rode, and they had invested as LPs in my first three deals. And so they basically pulled me aside and said, "Hey, let's go talk." And they're like, "Andrew, we like being LPs, but we know a lot of rich people. Let's actually be partners, and we can help grow this together." I'm like, "That sounds great." And so that was 2013. So that partnership has been together for 11 years, and you put it all together, it's like, again, about 2,700 units now. And so how we continue to grow and scale is, I realized that in the beginning, our weakness was ability to raise capital, and so we partnered with people that was their strength. The strength that we had, that we were working on, was finding deals, deal analysis. I'm a former engineer, operations, all those systems, but we weren't as strong on the capital side. And so that's how we grew the business, is we partnered with two different people, basically, or two different groups, to shore up the capital side. And that's how we were able to grow and scale. Of course, now at this point, it's taken on a life of its own, and grown, and our top investor source is referrals, so it's just kind of grows internally, but we still have those partnerships in place, and they've done really well. So that's how we did it.
Congratulations.
Yeah.
Yeah, I mean, and one of the other things, other than the creative deal stuff, which this is the first time you helped us really dive into that. The other thing that you're great at right now is having much more of your pulse on the world of multifamily than I do, or John might have more than me. But since we're outside that asset class, could you just kind of open up the book and tell us what's going on in early 2024 in the world of multifamily syndication investing?
Yeah, so transaction volume is 25% of what it was the past few years. It's still well below normal. There are indications that transaction volume will start to slowly but steadily increase throughout 2024 as, let's say, more motivated sellers come to the table, whether they want to or not. Everyone's heard much about the wall of maturing debt that is coming this year and next year, and that very much does exist. However, a couple of things mitigating that. Actually, let me step back a little bit. So multifamily pricing is down probably 20 to 30% from the peak, which was, I'd call, Q1 of 2022. And again, obviously that varies by market. If you're looking at a property in San Francisco versus a property in, a suburb of Atlanta, you're going to have very different results. But let's just call it down 20 to 30%. My feeling is we are probably at or close to bottom in terms of pricing in real time. Now, the data lags 6 to 12 months, so we're still going to see lots of headlines this year about prices coming down and all that, because it takes a long time for these things to trade, and once they go under contract. The reason I say that is, number one, there are a lot of loan maturities coming that are going to force people to sell because the properties are worth less than the loan, or they can't afford the payments, and those properties are going to end up being sold. Interestingly enough, there will be some more foreclosures, but I don't think there's going to be a massive amount, because what we're seeing is, number one, there have been sellers who are getting ahead of it, and they're getting it on the market before that happens. But two, we're seeing a lot of lenders do workouts where they're extending the loan for a year, or they're modifying the interest rate and giving more time, because the overall, right or wrong, the market consensus right now is that rates are going to be lower in the not too distant future, and therefore this problem is going to at least partially go away. So let's kick the can down the road and see what happens. And so that is very much the mentality right now. We're seeing more lender workouts than I've ever seen in 13 years. Also, Another deal that we are currently working on, we're hoping to get awarded the deal this week actually, is a lender approved short sale. 2 years ago, we never thought we'd be talking about how do you get a short sale on an apartment complex approved. Like that wasn't even thought feasible that you would even need to ask that question. So lenders are actually working with owners. I think they learned from 2008, like, hey, let's not get too aggressive taking this stuff back because it can cause, prices to decline further, and then kind of becomes a bit of a spiral. Now you have more properties that are upside down, and then it just kind of builds and snowballs. And then on the flip side of that is there is a ton of capital sitting on the sidelines waiting to scoop up these assets. In the last 2 months, the very few properties that we have seen trade, the buyer strength has actually been really high. Multiple offers. The last couple of deals that we bid on, even though they were off market and it was just a couple of buyers, they ended up trading for more than what the broker and seller originally thought they were going to trade for. So again, we're already seeing, 6 months ago, the broker would say 40 million and we'd offer 30 million and we'd say, sorry. And then they'd come back to us a month later. Hey, what about 37? No, a month later, 34. Now it's, hey, this is going to go for 40. Oh, actually a buyer came in at 41.5. So it's all in real time. The buyers are already starting to upbid a little bit. I don't think we're going to see wholesale price increases for a while, but it feels like the bottom is in because of the capital demand, because of the workouts, and operations are actually pretty good. Our portfolio, a third of the portfolio hit all-time records for collections in January, and the rest of it's really close to that. So operations are good. Capital demand is still very, very strong. Banks are at least working out some of this stuff. You put that all together, it feels like we're at or near bottom. 2024, 25, probably a great buying opportunity because in 26, we're going to have a massive supply shortage again, and we're probably going to be heading into the next upcycle. So we're really trying to collect quality assets for the next 2 years and then ride the next cycle. So,
dude, incredible advice. But let's break it down a little bit. You threw out a couple of generalities that in your mind are probably specific, and you probably have the facts or what you guess. What do you guesstimate when you say foreclosures were predicted to be big because of all the loan maturities needing to do a refi, but the value won't be there to do the refi? And everybody predicts, oh, foreclosure will be so bad. You're saying they're not going to be as bad. Can you give me ratios or numbers? What does that mean, less bad?
Yeah, that is tough to say because if number one, I mean, I hear different numbers every day on like this many billion of loans are coming due. And then what happens too is a lot of I just posted on LinkedIn about this. Wish I could remember the numbers, but they'll say, this many 100 billions in loans are coming due. But what they don't say is, well, when were those originated? Right. So this is one, again, when I say,
point.
Yeah, when I say the headlines are worse than it looks, it's because they say, 100 billion in loans are coming due. Well, if 40 billion of those loans were 10-year Fannie Mae loans that were originated in 2014, guess what? Those loans are fine. I mean, I'll give you, like, for example, we have a handful of properties that we've owned 7 and 8 years now with fixed 10-year debt. Our LTV is 37%. If I've got a loan maturity this year, I'm fine. And guess what? The interest rate today is actually the same as what I had on the loan that I originated 10 years ago because today's rates are actually normal. What wasn't normal was 2020 and 21 and 22. So am I in trouble with a loan maturing this year? No, but none of those headlines break that down. So yes, there is a ton of debt from 21 and 22 that's going to be a problem, but it's just not quite as bad as the headlines make it seem. And yeah.
I got a tough question for you though. You said rates are normal today, like what they were 10 years ago. The good news is I believe you. The bad news is there's another variable you're not mentioning, which is the cap rates from 10 years ago were probably 7-8%, right?
Yes.
And cap rates today, if you say there's capital sitting on the side, that means there's, let's call it fresh money. What are they willing to buy a multifamily at?
Really good point. So it's all about the cost of capital and what are the alternatives, right? So, yeah, I would say, in 2011, 12, 13, 14, something that you might buy for a 6 or a 7 cap, today might still be 5, 5.5. The cap rate cap rates have not expanded to the extent that they compressed over the last cycle.
And that's sophisticated language. Would you mind explaining it to the listener who's never heard these terms before?
Yeah. So everyone tosses around cap rate. It stands for capitalization rate, and basically the idea is how quickly does an asset pay itself off. So if you bought a $1 million property, all cash, and it has a net operating income of $50,000 a year, that's 5% of a million. Cap rate 5%. Okay, so that's what that means. And so the lower the cap rate, the more expensive that income stream is and the longer it takes to pay off. So as a buyer, the higher the cap rate, the better. So that's all cap rate really means. And for me, the best way to think of cap rate is just how does the market value an income stream?
Yeah.
So $100,000 coming off of a brand new apartment complex is less risky than $100,000 coming off of a 1960s mobile home park. And so that $100,000 coming off the mobile home park is going to cost you a lot less to buy and trade at a higher cap rate because there's more risk there. There's more management headache. And so cap rate really, like if you look at, we're talking about multifamily or self-storage or whatever it is, it's just how does the market value that income stream? And so what's happened is the government, really most governments around the world have printed so much money. There's so much capital looking for yield that the demand for an income stream today off an apartment complex is higher than it was 10 years ago. And therefore the capital is willing to pay more for it. And therefore cap rates are lower than they were back then for the same income stream. Right.
Pause right there. Everybody. That was phenomenal explanation. Hit rewind, go back 2 minutes and just listen to this 10 times because that's what I'm going to do, folks. Sorry, go ahead.
So I'll give you an example. So if you look at US money market accounts, the long-term trend for like 10 years prior to COVID was about $3 trillion in those accounts. In the last 3 years, that has increased as of, I think it was November of 2023, according to the St. Louis Federal Reserve, the balance in U.S. Treasury accounts was $6.14 trillion. The GDP of the world's third largest economy, Japan, is something like 4.5 trillion, right? So there is more money just in U.S. money market accounts than the third largest economy in the world. And right now that money is earning 5% or whatever. As yields come back down, or people look for higher yield, that $3 trillion's got to go somewhere. It's not all going to go to multifamily, and I sure as heck hope it doesn't, because I'll never get to buy a property again if I have that much competition. But that $3 trillion, just look, one of the greatest laws of economics and really physics and anything that you can always rely on is reversion to the mean. Right? Wow. Meaning you almost never exist on the mean. You're always above it or below it, but you're always going to revert to it. So when you look at the money market account and you say, all right, for 10 years, it's been 3 trillion. All of a sudden it's shot up to 6 trillion. It's going to come back down. Maybe not exactly 3 million, but it's going to, and that money is going to flood into hard assets, yield producing assets. So like when I say there's a ton of capital sitting on the sidelines, that's just one piece of that. And that's why I don't think cap rates are going to fully expand back to where they were, because there's so much more capital than there was the last time we went through this. In fact, part of what caused the Great Recession and the huge real estate collapse was a giant lack of liquidity. You couldn't get debt. You couldn't raise equity. There was no one to buy this stuff. Now it's the opposite. There is the secret's out about real estate. And yes, some deals are going bad. Some people are going to be taken out of the game. But there are literally trillions who said, oh no, we want to get involved in this now that there's another opportunity.
Andrew, you just made a lot of our listeners feel a lot better about the market right now than what they're seeing on whatever it is, CNN or Fox News or MSNBC, because it sounds to me like when you're watching that type of news, the sky is falling. But you just really, I think, brought a lot of assurance to our investors or our listeners. And talking about maturing debt is a big topic with a lot of investors. And it seems to me like a lot of people are holding on to their money, and that will raise competition because people have been so patient over the last year and a half. But it sounds to me like you're still actively buying. Like you're saying, like this isn't the time to sit on the sidelines. It's the time it's go. One speed, we go.
Hi, this is Melanie McCallan. Josh and I are just so grateful for the many investors who have already joined us at Accountable Equity. Accountable Equity is so much more than a capital group. It's really a community of accredited investors that want to learn and grow together. I just want to personally invite you, if you want to find out more about this type of investment and see if it's right for you and your family, please visit us at accountableequity.com.
Hey, it's Hal Elrod, author of The Miracle Morning, and you're listening to Capital Hacking. Enjoy.
We're trying to actively buy. So we're like I said, we came in second place on a phenomenal deal last week. We're hoping to get awarded one today. But for everyone who's like, I can't get a deal to work. We have analyzed 478 deals since the last one that we actually bought. And I don't remember
how long ago was that? When did you buy the last one? And you've analyzed about 500 deals.
The last one we closed on was March 30th of 2023. Right. Okay. So, no deal is better than a bad deal. If it doesn't work, don't do it. It's not worth it for so many reasons. So with all that, so give you an example though of how things are improving and why we're getting more optimistic is for 12 months ago, the gap between what sellers were asking and what we were offering averaged 26%. So if they wanted 10 million, we're offering 7.4. As of right now, that gap has narrowed to 13%, which is much more normal. We don't actually ever want to be consistently hitting asking prices because that probably means something's not right. But about 8% of the time, we're within 5% now. And if we're looking at a couple hundred deals a quarter, then that means we're going to get 4 to 6 properties a year, which is what we're hoping to do. So the bid-ask gap, or the spread between what sellers are asking and what buyers can offer, is narrowing. And that, again, that's another reason why it feels like the bottom is probably close in terms of pricing, because that spread is narrowing. And then another key factor is 6 months ago, if you went to get a loan from Fannie Mae or something like, they were going to give you 55% LTV. We just quoted 70. We just got quoted 70% LTV. Wow. Right. So once the lenders are, the biggest piece of the market is Fannie and Freddie. That's why I keep bringing them up. And they don't disappear just because there's COVID or recession. Like, they are there. Their mission is affordable housing and apartments and all that kind of stuff. When you see like if anyone's sitting on the sidelines and you're like, okay, boil it down. What is the one green light to look for? When you see agency loans at 70 to 75% LTV again, that's your green light. Because that means that the debt, the cash flow is high enough to cover that kind of leverage. It means the agencies are comfortable going back up to that level. That means that, tells you that they believe that asset values are stabilized and possibly going back up. That means that they have confidence in future operations. So if you want to boil it down to like one thing, like you're sitting at the stoplight, that to me would be it. When you see loans going 70, 75%.
I don't know if there's ever been a better show. I mean, this is a tactical, practical masterclass show that, and Josh are going to get rich after this.
Josh loves that you use the car analogy there, that you're at the stoplight. And
so, boy, my breath was taken away with the one green light thing. That's like clickbait stuff right there. We got to maximize that. That was cool.
Yeah. Well, and I do want to add the caveat. Where I'm definitely not saying, hey, everything's easy and great from here and there's no challenges and there's not going to be foreclosures. And it definitely bears cautious navigation, but this is the opportunity, right? Everyone and their mother can quote Warren Buffett about buy when others are, fearful and sell when everyone is greedy, right?
Wait, I never heard that one. Let me write that one down real quick.
Yeah. But nobody can actually execute it. Because when you're in the moment, it's like, well, yeah, but there's all these loan maturities and insurance is going high, right? But that's just it. Like, that's why everyone's fearful. And you have to set yourself aside and say, okay, these are real risks. Yes, you got to pay attention to them. Yes, you got to mitigate it. But that's where the opportunity is, because by the time everyone figures out those risks are gone, it's back to 37 offers and good luck getting a deal and good luck getting a good basis. So
I've been waiting to ask two questions. One is about Marcus Millchap and the brokerage, and one is about Florida investment. Florida, with that high insurance and all the fear of, the fact that it's very hard to even get insurance in some parts of Florida. Are you willing to look at Florida, or have you nixed Florida because of those risks?
So we own in Florida. Some of our best assets are in the Florida Panhandle. We do still look at Florida. We will not buy something that is literally on the beach. We've had a few properties come up that have waterfront views, and we're not going to do that. But we own, oh gosh, let's see.
Wait, why won't you do that?
Because that's where the insurance is just gone up 500%. We looked at one where the insurance was $8,000 a unit per year.
Oh, wow. That's a lot. Now
on the beach. Yeah.
But the truth be told, I agree with you, but there's going to be a day where the world either prices that in, or it comes down a little bit, or they just price it in, as I mentioned. At that point, isn't it going to be viable again?
Well, it is still viable. So we own about 600 units in the Florida Panhandle right now, and our insurance has gone up, not as much as the headlines would suggest. I think we were up 67% last year. But don't get me wrong, that's big.
That's bad. Yeah.
But when our rents have gone up, our revenue has literally doubled there in the last 5 to 6 years. So we're still ahead of pro forma. Even though our insurance went up 60%. So would I do those investments? Yeah, all day long. So number one is you just have to factor it in. Don't under budget for insurance, and put that into your underwriting. And yes, that might mean, that's part of why that market's slow right now, is because, buyers are just like, well, I got to underwrite for 2,000 unit insurance. And the sellers are like, well, mine's 400. And well, you're underinsured. And then also keep in mind, the insurance market cycles just like any other financial instrument. When premiums get sky high like they are now, other companies and carriers say, oh, wait a second, this is pretty profitable.
That's very wise of you to bring this up. That's what other people have told me too.
Yeah.
So if you were to model very, very high insurance and the numbers work, you'd have to assume higher rents, or else it won't work. But your hope is that the new cycle will be extremely high premiums, bring more insurance carriers back into those markets, is your point.
Exactly. And I would say, always don't bet on that, but, always underwrite and structure your investments to the most probable case, and then hedge against the outliers.
Right.
So if your deal works with sky high insurance and continued increases, and then you say, okay, well, look, if insurance stays high and keeps going up, this deal is still a good deal. And then if it does come down, you win, right? So you kind of just same thing with structuring debt and all that. You invest to the most probable outcome, but hedge against the outliers.
I got to ask you this. Nobody else I know is doing 478 analysis a year. So in that, let's talk about the world of brokerage. Is it, and you talked about the spread of bid, the gap between someone selling it and offering is 26%, is now down to 13% from your observations. Let's talk about that. Is that because the brokers are helping push the sellers to persuasion?
There's been an interesting shift. A year ago, the brokers were, well, actually, man, time goes by fast. That's probably 2 years ago. You would see brokers bringing a property out, and every time you talk to them, it's like, price has gone up this much more. And part of how they would get sellers to bring a property to market is they'd say, we think, fill in whatever sky high price, we can probably get this for you. And sellers like, well, all right, if you can hit that, we'll do it. Now it's very much changed where, and that's part of why transactions are so low, is because sellers still have those 2022 numbers stuck in their head. Well, no, I want 10 million. Sorry, it's worth 7 today. The brokers learn quick and adjust quick, because their livelihoods are based on, they work for free. If a property doesn't sell, they just worked for free for 6 months. Totally. And nobody wants to do that. And so they're pretty smart, and they adapt. Now, generally speaking, if a property is being shopped, the brokers have actually vetted it pretty well, because over the last year, that's happened to them a lot, where they'll take a property out either full market or privately, and they'll spend 6 months doing tours and getting buyers and all this, but the seller was never really committed to it in the first place, right? The seller wanted an unrealistic number from 18 months ago or whatever. Whereas nowadays, the brokers are vetting them and saying, look, we're not going to spend our time on this unless you really are going to sell the property. And by the way, here's the market today. Are you good with that? Do you understand this is where pricing really is? And I think that's part of why we've kind of seen that little bit of a flip where deals are going back to trading above kind of the target, is because the brokers have done a really good job of setting expectations and only bringing realistic deals to market. So.
Dude, I have so many more questions, John, but you go.
Yeah. And again, these are lots of generalizations. I mean, there's going to be exceptions all over the place. But again, you got to start with the most likely, most probable case. So.
That when you were talking about the margin from what you were bidding and what they were asking, the asking price was, that kind of went through my mind that the agents are managing much better with their clients and saying like, hey, we're not going to spend X amount of time because it's just totally unrealistic. And where do you see, from what I'm hearing is there's probably another rate drop coming in the spring. Is that something that you're guesstimating?
If I were to guess, I think the first, call it 25 basis point cut's going to be May or June, as long as we don't get a second hot CPI reading coming out next month. But also I would put the caveat that while that first rate cut is important in that the importance is not the rate cut itself. The importance is the very clear, direct signal that the Fed has shifted its mindset and shifted its direction. Like, we are now in cutting mode versus higher for longer. That's the importance of it, because candidly, the Fed raised rates 500 something basis points. Dropping at 25 is not going to make a difference. If you've got a loan maturing at the end of this year and the rate's currently 500 basis points higher than you thought, and now it's 475, you still got a problem regardless of whether or not the Fed cuts. So any Fed cuts this year is not going to meaningfully rescue a whole lot of deals, except maybe the few that are right on the margin. So I do think they probably threw out the first cut, call it June, maybe May. At the same time, I don't think they're going to do anything too drastic either direction, because it's an election year and they don't want to be accused. I mean, obviously there's politics involved, but they don't want to be accused of being overly political. So I think there's going to be a little bit of maybe throw a few rate cuts out, but don't rock the boat too much. And then by the time we get to 25, I'd say the most probable outcome is we see, the Fed funds rate down to 3.75, 3.5, and right now the bond market is predicting that's where it bottoms in 2025. Whether or not we actually get there, who knows? China, Germany, Japan are all in recession right now. That's deflationary. We have two wars going on. That is inflationary. There's so many competing factors. Who knows? And then that's assuming everything, we don't get some other crazy thing happening in the next 12, 24 months. So
now you understand why we've had you here 3 times now. This was incredible, John.
Yeah. Truly honored.
I love talking with you guys. I could do this all day long.
So as we come to a close here, where do people find you, Andrew?
If it's not surfing or skiing in the mountains, they can find me. I'm not a social media guy except LinkedIn. Our friend David Green says I'm a walking LinkedIn. So I'm like, maybe I should actually use that. So I do post regularly on LinkedIn. And if you comment, that actually is me replying to you. It's not a VA in the Philippines or anything like that. So LinkedIn. And then our website is, if you Google Vantage Point Acquisitions, the website is vpacq.com. There's a couple of tabs on there to get connected with us. And love meeting new people and sharing information, and love of real estate.
Thank you, buddy.
Thank you so much, Andrew.
Damn straight.
We just got
buddy.
We got to the end of another great show. And everyone listening right now, you're the family and friends. Thanks for staying till the end.
That was so fun. And hey, hit the like, hit subscribe. We're here to serve you guys. That's why we're doing this show. Josh is not paying me. I'm doing this off of my quote unquote sweat equity because we want to make a difference in your life. And then that ripple effect will continue to touch the world.
Hey, amen, brother. Please check us out on capitalhacking.com, all the social media threads. And yes, I know you've probably already sent this episode to one of your best friends. Thank you. We love you. Just go right into your iPhone, hit the plus symbol. We'll talk to you later. See you next week.
Share.